I want to start here. I have a massive amount of respect for people who are self employed. If you're running a business, you're doing two hard things at the same time. You're keeping a business alive and you're paying yourself enough to live. You're covering expenses, managing uncertainty, dealing with swings. And on top of that, you're saving for a down payment and trying to buy a home. That's not easy. That's impressive. And yet, this is the group that gets denied the most. So if you ever thought, I make real money, how am I the one getting rejected? You're not crazy. Let me explain what's actually happening. Here's a core problem. Self-employed people think in real world cash flow. Money comes in, expenses go out, what's left is income. Lenders don't see it that way. They're not asking, can you afford this right now? They're asking, how predictable is this income if something goes wrong? So lenders read income backwards, not forward, and they only trust what's documented, taxable, and repeatable. Same borrower, two completely different financial languages. That mismatch is where most denials start. Let me give you a real example. A couple of years ago, I worked with a self-employed borrower. I'll call him Alex. Alex ran a small service business, nothing flashy, but solid. His business deposits were consistent, money coming in every month. He had cash saved. He wasn't over leveraged. On paper, he looked like someone who should qualify. But when he went the traditional route, he got shut down. Why? His tax returns showed very little income. Not because the business wasn't doing well, but because he was doing what most self-employed people do, writing off expenses to run the business efficiently. From his perspective, he was responsible. From the lender's perspective, the income wasn't usable. So we stopped trying to force the wrong box. Instead of asking, how do we make the tax returns work? We asked a better question. Where does the real money actually land? We looked at his business bank statements. We separated real revenue from transfers. We averaged the deposits over time. Same borrower, same business, completely different outcome. He bought the house. Nothing about his business changed. Nothing about the market changed. What changed was the lens. If you're self-employed and getting denied, this is usually what's happening. Traditionally, self-employed borrowers qualify using tax returns, usually 2 years of personal returns, sometimes business returns. And lenders, they don't care about the revenue, they care about the net income after the deductions. Here's the trap. Most self-employed people are smart about taxes. They deduct expenses, they lower taxable income, and that's great for the IRS, but lenders only see what's reported. So even if you feel like you're making a lot of money, the mortgage system might say otherwise. That's not irresponsibility. It's optimizing for one system while applying to another. This is where bank statement loans come in. They exist specifically because tax returns don't tell the whole story for anyone that's self-employed. Instead of tax returns, lenders analyze 12 to 24 months of deposits from where your real business revenue lands. Now, here's an important clarification. This matters. Not all deposits count. Lenders are looking at your primary business account or a personal account where your client or customer payments are deposited. They're not counting transfers between your own accounts, loan proceeds, gifts, or even your saving movements. They average real business deposits over time to calculate income. That's how they translate your reality into their language. Now, let's be honest about the trade-offs. Bank statement loans usually require a larger down payment, often between 15 to 20%. They also want to see stronger reserves, typically 6 to 12 months. Rate pricing varies by lender and structure. The key difference isn't the rate. The real difference is risk mitigation upfront. You're putting more down. You're holding more in reserves. That buffer is what makes lenders comfortable approving loans without traditional tax return proof. You're not being punished, you're buying flexibility. So why do denials still happen, even with bank statement loans? The big one I see is one, debt to income issues. Deposits are overstated, ineligible deposits are included, and obligations too high relative to the income. Two, commingling funds. Business and personal money are mixed. That forces different income calculations and usually lowers qualifying income. The third, insufficient reserves. These loans require real liquidity. Retirement funds may only partially count. And the fourth, credit profile issues. It's not just a score, Lenders want active trade lines with history. The authorized user accounts don't count. And one more important note here, bank statement lenders are often more flexible than traditional banks. If your credit isn't perfect, but your cash flow is strong, you may still have options that banks won't offer. Here's where timing comes into play. Sometimes the right move isn't applying today. Sometimes it's letting a stronger year of income season, separating business and personal accounts, building 6 to 12 months of reserves, waiting until income stabilizes. Waiting without a plan feels like rejection. Waiting with structure creates leverage. That's the difference. Being self employed doesn't disqualify you. It just means structure matters more, timing matters more, product choices matter more. This isn't a rate conversation. It's not a sales conversation. It's a planning conversation. And when that alignment is right, approval stops feeling like a mystery and starts feeling predictable. If you're self employed and trying to figure out whether you're ready now or later, that's exactly the conversation I like having. No pressure, no rush, just clarity. Thanks for watching. I'll see you next week.